How many parents are quietly draining their own retirement to help their adult kids? More than you'd think, not in a dramatic one-time way, in a slow, steady, almost invisible way that most people don't add up until years later. And once you see the numbers, the whole picture will make sense. Let's define what we're actually talking about. This is often called the bank of mum and dad. It's not a real bank, obviously. It's the informal, unofficial system where parents cover rent, help with a down payment, chip in on student loans, cover a car payment, or bail out an emergency expense for a grown child. No paperwork, no interest rate, usually no real conversation about when or whether it ends. And that last part matters more than people realize. A real bank has terms. It has a repayment schedule, an interest rate, a clear start and a clear end. The bank of mum and dad usually has none of that. It just quietly stays open, month after month, year after year, often without either side ever agreeing on what it actually is. And here's the number that stops most people. According to Pew Research Center, a majority of parents with adult children say they've provided financial support to at least one of them in the past year. Some surveys put that figure near 6 in 10. That's not a small group of overly generous outliers. That's most parents. So why does that number surprise people? Because most of us picture financial dependence as a young adult problem, something that ends around graduation, or maybe a few years after. But the data doesn't support that story. A lot of this support stretches well into a child's late 20s and 30s, and a lot of it is happening while the parent giving it is in their 50s and 60s, which, not coincidentally, is the exact window where retirement savings are supposed to be accelerating, not shrinking. Here's where it gets more layered. According to research from Merrill, Lynch and AgeWave, parents of adult children collectively spend around $500 billion a year supporting them, which is roughly twice what those same parents contribute to their own retirement accounts annually. Twice as much. Think about that ratio for a second. For every dollar going toward their own future, parents are sending $2 out the door to help their kids right now. That's not a rounding error. That's a structural pattern. And it shows up again and again across different studies, different years, different survey methodologies. Merrill, Lynch and AgeWave also found that most parents say they've put their child's needs ahead of their own retirement savings, and a majority say they'd be willing to make a major financial sacrifice, including drawing down savings, to help an adult child. But here's the thing, none of this makes these parents reckless. It makes them human. Love doesn't check a retirement calculator before it acts. And that's exactly why this pattern is so persistent. It isn't driven by bad math. It's driven by an emotional instinct that's almost impossible to override in the moment, even when the parent logically knows better. So let's talk about what that instinct actually costs. Not in feelings, in dollars. Here's a simple example. Say a parent pulls $10,000 out of a retirement account at age 55 to help a child with a down payment or cover a rough patch. That $10,000 doesn't just disappear as $10,000. If it had stayed invested and grown at a historical average of around 7% a year, by age 70, 15 years later, it would have grown to roughly $27,000. So the real cost of that withdrawal isn't $10,000. It's the difference between $10,000 and $27,000. It's the compounding you never got to see. And this is where things get interesting, because most people don't think about money this way. They think about the $10,000 they gave. They don't think about the 15 years of compounding that money would have quietly built in the background without them lifting a finger. That's the hidden cost, not the transfer itself, the years of growth that transfer took with it. Once you understand that, the Federal Reserve's survey of consumer finances data starts to make a lot more sense. That research consistently shows that transfers from parents to adult children are the most common form of financial transfer in American households. Far more common than transfers flowing the other direction, from child to parent. Money tends to move down the generations long before it ever needs to move up. And for a lot of families in their 50s and 60s, that downward flow is happening at exactly the moment their own retirement window is closing. Rowe Price's research on family financial behavior points to the same pattern from a different angle. Parents who are financially supporting either aging parents, adult children, or both, sometimes called the sandwich generation, are dramatically more likely to have pulled money from retirement savings than parents who aren't in that position. In their surveys, dual caregivers were roughly 3 times more likely to have tapped their retirement accounts. 3 times. That's not a marginal difference. That's a completely different financial trajectory. And EBRI, the Employee Benefit Research Institute, has tracked something related for years. Americans' confidence in having enough money for retirement has been sliding, and financial obligations to family members are consistently cited as one of the pressures behind that decline. Vanguard's own research on saving behavior shows something similar. Households juggling multiple financial priorities at once are far less likely to hit their own retirement savings targets, even when their income looks perfectly fine on paper. So here's the emotional pivot, because this is the part that actually matters. Most parents already know, on some level, that this trade-off exists. They're not confused about the math. They know that money spent now is money that won't be there later. But knowing something logically and acting on it emotionally are 2 completely different things. And that gap between what parents know and what parents do is where this entire phenomenon lives. Here's where things change though. Because there's a second data point that reframes the whole picture. Pew Research has found that adult children whose parents experience financial hardship in retirement are significantly more likely to face financial strain themselves. Read that again. The generosity that feels protective in your 50s can quietly set up a second problem in your 70s or 80s, one where the child who once received help ends up being the one who has to provide it. So the bank of mum and dad doesn't just cost the parent. If it goes too far, it can eventually reroute the burden right back to the child, just later and with higher stakes. This is where the oxygen mask idea actually applies, not as a lecture, but as a fact of arithmetic. On a plane, you put your own mask on first, not because you care about the other person less, but because you're useless to them unconscious. Retirement accounts work the same way. A parent who protects their own financial footing has something durable to offer for decades. A parent who quietly erodes that footing to help right now may run out of runway to help later, or worse, need the help themselves. So what does this actually mean for you, watching this right now? It probably doesn't mean cutting off support entirely. Most people aren't going to do that, and honestly, most people shouldn't. It means treating your own retirement contributions as non-negotiable, the same way rent or a mortgage payment is non-negotiable, before discretionary help gets decided. It means having an honest conversation with your adult kids about what you can actually afford to give, on what timeline, and under what terms. Because a clear boundary stated in advance causes far less damage than a resentful one stated after the money's already gone. And it means being precise about whether something is a gift or a loan, because the two get treated very differently in a family relationship, and blurring that line is one of the fastest ways to turn generosity into conflict. None of this is about loving your kids less. It's about making sure the love you show them today doesn't quietly turn into a burden they have to carry for you tomorrow. The parents who help from a position of strength give their kids something real. The parents who help from a position of erosion often end up needing that help returned, just later, and with more at stake for everyone. Most parents will never regret loving their kids too much, but a lot of parents end up regretting that they never sat down and did the actual math before the money left the account. And that's really the whole point here. Not less generosity, just generosity with your eyes open. So here's the question worth sitting with. If you're currently helping an adult child financially, do you actually know what it's costing your own retirement timeline? Or are you avoiding running that number because you're afraid of what it'll say?